Good afternoon, good morning. Welcome to Getting Started with Options. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined by my good friend Michael Fairborn out there in the chat, filling in for Cameron May today in this discussion. And this is a great opportunity for me to spend a little bit of time talking here in the webcast environment about something that I talk quite a bit about when I'm out on the road teaching in our live events, and that is the understanding of how do you get started trading options? And so we're going to spend a little bit of time talking about the concept of time. I thought this was appropriate given the fact that we've just changed our clocks this last weekend, and the idea of time and time decay and what that means for options trading. So my thanks to Michael Fairborn for being here. My thanks to all of you for being here today as well, whether you're in the live session or the recorded session. Be a part of the conversation. Chat in your questions. That's why Michael's here to help answer those questions. If you're in the recorded session, by all means, leave us a comment or a question, and we will respond to that as quickly as we can. A couple of quick housekeeping items as we get started here today. Remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Remember that everything that we talk about, simply for illustrative and educational purposes only, is not any kind of a recommendation or endorsement or advice. We're going to talk a little bit about technical analysis and a lot about probability analysis in this discussion today. Remember, the technical analysis, probability analysis, fundamental analysis are all theoretical in nature, and none of those are guarantees as to what the market might do. And therefore, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Remember that investing involves risk, including the loss of principal. Also, just a couple of quick reminders. Anytime you're short an option, it's an equity option, it's American style, there's the potential that that option could be assigned early. So just be aware of that fact. Also remember that we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform. Not a guarantee of future success, but a great sandbox in which we can play and practice and learn. There are some things, however, that the paper money environment does not do that a live trading environment will do. Namely, doesn't facilitate the early assignment of short options. So be aware of that as you're moving your practice from live trading to, or from paper trading to live trading. Also keep in mind that stop orders don't guarantee the price at which that order is going to get filled. We can specify the activation price, but not the execution price. And in the event of a stop limit order, there's a potential that the order could be traded around entirely and that order would not fill. So let's talk about this idea. And Future Divide says, help me understand the principle of option trading in layman's terms. And that's what we strive to do. By the way, one of the things that I do on a regular basis is I teach our live in-person workshops. One of those workshops topics that we teach is option strategies, or basic option strategies. We spend one day teaching technical analysis and one day teaching option strategies. And as we do that, we spend a fair amount of the time in that particular day, in that option day, talking about option basics, option mechanics, how option contract pricing works, those types of things. And then we spend a little bit of time talking about the option Greeks. And I've got that here on this page, on this disclosure page as well. We can bring that up just one more second here and define this. These option Greeks are the kind of dashboard that help us to measure the sensitivity of an option premium, the amount that we pay or we get paid for that option, to things that might be changing. So delta is the option Greek that measures the sensitivity to changes in the price of the underlying stock. Gamma measures delta's sensitivity to changes in the price of the underlying asset. So gamma is kind of like the delta of delta. Vega is the measurement of sensitivity of an option to changes in the volatility of the underlying asset, changes in supply and demand. The one of these option Greeks, however, that is really dependent on something that is external to the underlying stock is the passage of time, and that's theta, measures the sensitivity of an option to time decay. So I would argue one of these things is not like the others. One of these things just isn't quite the same. Theta is a little bit different when it comes to the option Greeks. And so we're going to spend a little bit of time talking about theta and time value. So I want to talk through this really quick, and then we're going to jump out to the platform and we're going to take a look at a couple of examples, and I'm going to give you some insights perhaps into how you might analyze how you might analyze the impact of time decay and how you might work to put that in your favor. So we'll talk about this. So time decay as an option buyer, if we are a buyer of an option, time decay is going to work against us generally, right? The advantage in time decay, or the risk in time decay, is as a buyer of an option, the value of that option, the extrinsic value of that option, decays away as we get closer to expiration. So holding on to an option all the way till expiration is going to result in one thing happening for certain. If we hold that all the way till expiration, is that at expiration, all of the extrinsic value, or all what we sometimes refer to as time value, is going to be gone. At expiration, we know that there is no more time value. And that's working against us as an option buyer. So what's working for us as an option buyer is directional price movement. The price of the underlying stock moving up if it's call option, or down if it's put option. But the thing that we also know is that the rate of time decay is not a linear function. It doesn't function in a straight line from where we enter the trade down to zero. It would be nice if it did, because that would be maybe a little bit more predictable. But what we do know is that it does take this logarithmic function. Now, I'm going to say one thing, and then we're going to come back to this really quickly. This curve that we're looking at, that blue line curve right there, represents, let me kill those annotations first so that I'm not making this confusing. But this blue line curve right there represents the rate of time decay, or the time decay graph of an option that is at the money, ATM. At the money is simply a marker, simply a reference point of an option that is simply mathematically closest to the current trading price of the stock. So this is kind of the ideal curve, if you will. If you were trading the at the money option, this is what that curve is going to look like. It changes a little bit. It changes a little bit when we go out of the money or we go deeper in the money. And I'll show you what that looks like here in just a second. So keep that in mind. This is the representation of the at the money curve. So if we're trading this, if we're going long a call or we're going long a put and the stock's moving directionally, ideally the movement of the underlying stock and then delta is going to overwhelm the passage of time, especially if the stock makes a big move quickly. That can benefit us as an option buyer faster than time decay can eat away at that option premium. So if we think about it, we have there is a benefit as an option trader, as a long option trader, buying a call, buying a put, to having the stock make a big move and having it make a move very quickly. We lose some of that advantage or some of that benefit if we hang on to a trade too long. But there is kind of a characteristic here. There's always a balance. And I'm just going to draw this balance beam. The longer we go out in time towards expiration, meaning the more time that we buy, right? We buy more time, our cost is going to be higher. Those longer dated options generally going to be more expensive simply because there is more time for the stock to make a move. So the tendency for option traders oftentimes, and you might recognize this in yourself, is to go shorter on the expiration cycle curve because it's cheaper, it's less expensive. And as option traders generally, just like everybody else, not that options traders are all that different from everybody else, although they are kind of a little bit different, but option traders tend to buy cheaper options, looking for a bargain, if you will, looking to pay less. But what we have to remember that balances out this function right here is the fact that in an American style option, we have the opportunity, especially if it is a liquid underlying stock and we're trading liquid options, we have the opportunity to sell that extra time value back to somebody else at a later date. Because that's kind of the goal here. Generally, we're not looking at using the right that our long option gives us, either the right to buy the stock at the strike price or the right to sell the stock at the strike price in the case of a put option. We're not looking to exercise that right. We're looking to buy the contract when it's cheap or inexpensive and sell the contract when it is dear or more expensive. And we can do that in a couple of different ways. One, we want to see the stock move. Two, we want to avoid time decay. We want to be able to sell that time value back to somebody else. So don't think about it as kind of a zero sum, that time decay has to go all the way to zero, or that we're going to look at exiting the position as we get to zero. So the concept is we might buy a little bit more time than we think that we might need, because we can sell that time back to somebody else at a later date, hopefully for more than we paid for it. But there are a couple of other things that we also know. One, time only moves in one direction. It only goes forward. We're always slipping into the future, right? Time decay only moves in one direction. It doesn't go backwards. Even though this last weekend, we turned the clock back. I've used this on stage all the time. I say, time can only go one direction. We can't turn back time. And last November, we were in Washington, D.C., and I was on stage in Washington, D.C., teaching this concept at a workshop. And I said, we can't turn back time. And somebody raised their hand in the audience and they said, yeah, you can tonight, because it was Saturday. They said, you can turn it back tonight because we turned the clocks back tonight. And I'm like, okay, thank you for being a smart aleck, but I get the point. That's what brought me to this discussion today, was the fact that we can't really turn back time. It only works in one direction. But we can put it to use in our favor as the buyer of an option. So if we buy when there is a slow rate of time decay, and we look at selling that option when there is a slightly more accelerated rate of time decay, but before it falls off the edge of the curve, then that maybe benefits us as an option buyer, because we're not suffering from that passage of time as significantly. So if we look at, say, for instance, and here's okay, there's a couple of interesting concepts here. If we're buying, let's say, at 150 to 50 days out, generally that rate of time decay is going to be, yes, you could get a DeLorean. You're right, Wiley. Absolutely. By the way, just the 40th anniversary of Back to the Future this last weekend, by the way. Speaking of that. So if we buy an option at 150 to 50 days out to go until expiration, and then we look at selling somewhere in this 40, maybe to 30-day time frame, or 30 days till expiration time frame, then what we're doing is we're kind of putting ourselves in this flat portion of the curve. So we might buy out here, buy the option here, and then look at selling the option here. And that helps us to avoid kind of this biggest chunk of that time decay. Now, if we're the seller of an option, let's say we're selling a covered call, or we're selling a cash secured put, or we're selling a short vertical spread, or we're selling an iron condor, or some other multiple leg option strategy, then what we might consider is looking at selling somewhere in this time frame to start the transaction, and then look at buying that back somewhere closer to expiration, when it's done the majority of the work that it can do for us. So for the seller of an option, we want to look at selling when we're on the accelerated portion of that time decay curve. There's a challenge here, because remember I said that this was the at the money curve. So we'll see what that looks like here in just a second when it comes to being the seller of an option, because there's an interesting insight that we sometimes overlook and can take advantage of. Now, the other thing I want to think about is some traders don't trade options, don't buy long options 150 days out and then sell those long options 40 days out. They maybe move to kind of a different perspective. Maybe they say, okay, I'm going to buy this option at 30 days to go until expiration, and I'm going to sell it back at 15 days to go until expiration. Or they might buy it at 45 and sell it at 20, or whatever it might be. The thing about this, and I know Michael Fairborn has talked about fractals before when he's been teaching technical analysis. I know that Rachel Dashell, who's our newest coach, by the way, talks a lot about the idea of fractals when it comes to technical analysis and things like Fibonacci's and so forth. But here's the kind of cool thing about this logarithmic curve is that any section of this logarithmic curve that we were to evaluate over a period of time is going to look exactly the same. It's going to look fractal. So if we were going to zoom, so I'm going to try to do this with artwork and see if you can understand what it is that I'm trying to convey here. If we were to look at this particular time frame right here on this graph, and we were to zoom in, so I'm gonna kind of make this a zoom, and this is what we were looking at in that zoom, we would still see that same type of logarithmic graph. It would just be over a shorter time frame. Does that make sense? So any segment of this logarithmic curve that we look at is going to be a very similar fractal fragment of that time decay curve. So if you are a shorter term trader, the same concepts apply. The same concepts apply. You want to be buying when that curve is flat and selling when that curve starts to accelerate. Whether that is 150 days and 40 days, or it's 90 days and 30 days, or 60 days and 15 days, or 30 days and 7 days, it doesn't matter. Now, Myron asks a great question. Why is this curve exponential or logarithmic and not linear? And the reason for that is really interesting. It's because, and we would think, what, it would just be kind of a matter of utility. But it's because of probability and probability of movement of the underlying stock. Each day that goes by and each day that drops off of this curve now takes away another opportunity for the price of the stock to make a particular move within its expectation based on volatility. So as we get closer to expiration, there's fewer days for the stock to make a move. Therefore, each one of those days becomes more important in the lifespan of the option. And therefore, that rate of theta decay, the rate of impact on the option value, and again, it's a function of utility, the rate of impact on that option value becomes accelerated as we get closer to expiration because there's less time for the stock to move. Think about it this way, and I thought about this, I kind of realized the impact of this back when my daughter went to college a couple of years ago. And I said, at the beginning of the summer before she went away to school, I thought, wow, cool, we've got the whole summer. We're way out here. Let me kind of illustrate this, and kind of illustrate the characteristics here. We're way out here at the beginning of this time frame. So if this is, the beginning of summer right here, and this is the day she's going away to school, way out here, all of this time, each day that goes by is not so significant, because we got a lot of days still ahead of us to go until she goes away to school. So if I miss one of those days because I've got to go to a workshop or whatever, it's not as big a deal. But now I get down here to, the last couple of weeks to go until she goes away to school. And if I miss a day with being able to spend with her to go to a workshop, that becomes much more significant because there aren't that many more days in that summer remaining for me to spend with her. And now I get down to the last couple of days to go. And if I were to miss that last day or those last couple of days, that becomes emotionally very significant to me because those were the last ones that I had. So they were of greater utility and greater meaning closer to expiration. You're right. Every day matters at the end. Back here, not so much. Now, every day matters for sure, but it doesn't matter to the same significant degree. So it's a matter of utility. So that's the reason why this becomes a logarithmic curve and not a linear curve. Now, it changes when we change the strike price, however. Okay? And so that's one of the things that I want to talk about in this context. And I'll show you how I got to that. Now, let's talk about this in terms of a trade. Let's look at a trade example. So what I'm going to do now that we've got this as a backdrop, I want to pop over here to the Thinkorswim desktop software platform. And I'm taking a look here at Amazon. And the reason I'm looking at Amazon for a very simple reason is that it has seen a breakout in the last couple of days. Oh, by the way, speaking of breakouts, we have a feedback survey there in the chat. Do me a favor. You can do it right now. You can do it later. Click on that link, open up that feedback survey and set it aside. And then you can go back and you can fill this out, that feedback survey out at a later time so that it doesn't expire at the end of the webcast. Because if you wait and you don't fill out the feedback survey, it's going to expire and you won't have the opportunity to fill it out. So take the opportunity to open it up right now and then you can fill it out at your leisure. You've defied the passage of time. All right, the reason I chose Amazon is, one, it's a fairly liquid stock. Two, it's just in the last couple of days had an earnings announcement and it's broken through this level of resistance and it's made this move to the upside. Three, it's giving me a little bit of a bounce. Four, I've got a 50-period simple moving average on here that's just started to turn higher. So it's a bullish stock. So I'm going to look at this from the function of a bullish long call to take advantage of that bullish upward movement. Okay, or that potential. I don't know for sure that it's going to do that, but that potential bullish upward movement. So I'm not going to buy the underlying stock. I'm going to buy a long call. So here's what I'm going to do. I'm going to go back over here and we're going to go to the trade tab for this option or for this stock. And I'm going to go to the trade tab. Here's Amazon. I'm going to delete that and I'm just going to open these up. And so notice I've got all of these expirations. I've got everything from 3 days to go until expiration on out here to the 21st of January, 2028. That's 808 days to go until expiration. There's a lot of time for the stock to make a move. Now, what I want to illustrate here is how you can kind of see what the market expects the stock to make in a particular time frame. And that is kind of an indication of the utility value of this time decay. So come over here to the right-hand side of the chart. And you say, all right, I've got this number that shows implied volatility, but just to the right of that, there's this number that's a plus or minus, and it's 7.2 or $7.21, right? And you come down here to the one that is 800 days to go until expiration, and it's about $111.15. So you notice that these moves way out here based on that implied volatility are pretty close together. Now we start to see a bigger disparity here as we get closer to expiration, 17, 15, 11, 7. That expected move is smaller because there's less time for the stock to make the move. This is the expected move, plus or minus, from where the stock is right now in that time frame for that expiration. So in the next 3 days, the market expects Amazon to move up or down $7.22. Will it do that? Don't know. No guarantee. This is not a guarantee of how far the stock will move, but a projection of what the option market thinks it might move. So we go way out in time. We say, wow, 111 points up or down from 250 is, 361 or 149, right? That's a lot of move from up or down from there. That's a big move. But the stock has a lot of time to do that, 808 days, and it's got a lot of time to recover from that type of move. So we're going to kind of use that as a measure. So what we're going to think here is, all right, I think the price of the stock, my directional opinion is that the price of the stock is going to move higher. So what I want to do is I want to get out on that longer part of that time decay curve where it's relatively flat and the rate of time decay is shorter or is smaller. So what I'm going to do is I'm going to change my layout here to just showing, you know what, I'm going to do this. I'm going to customize this and I'm going to say, I'm not worried too much about Vega, so I'm going to remove that. I just want to show delta and theta, directional sensitivity and time sensitivity. So I'm going to click on OK. And now I'm just showing delta and theta. And what I'm going to do is I'm going to open up each one of these expirations. Now we're going to keep it at the money strike. So what I'm going to do is I'm going to open up each one of these expirations and I'm going to make this just, you know what? I'm going to make this 4 strike prices. So all we're really seeing is the at the money strike. Stock's currently trading at 250. That's convenient because what we're going to be looking at then is the 250 strike as our at the money strike. So our theta component, the amount of time of value of this option premium that's going to go away per day right now, 3 days to go until expiration at the money strike is about 59 cents. Every day that goes by, about 59 cents is going to go away. If we go out to 10 days, that goes to 28 cents per day. You see how that's rate of time decay is slowing down. If we go out to 17 days to go until expiration, 22 cents. We go out to 24, 18 cents. We go out to 31 days to go until expiration. That slows down to 16 cents. It's about half or less than half of what it was here towards or very close to expiration. Now we go way out here. Let's go out to close to 150 days to go until expiration. It's half of what it is at 31 days to go. It's 9 cents. And if we go way, 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 way out on the time decay curve, we go way out to January 21, it's only 4 cents per day that's coming off of our option premium. We got 808 days to go, so that's a pretty slow rate of time decay. It's not working against us very hard. But the trade-off is, you might think, wow, cool, I'll just buy out to 808 days and I can sell that option premium to somebody else. And you're right, but it's going to be expensive. And there are traders that do that. There are traders that buy LEAPS options and other long-dated options. LEAPS just simply stands for long-term equity anticipation security. And it has a lower rate of time decay. So if we kind of balance this and we say, fine, I'm going to buy an at-the-money option. It's 136 days to go until expiration. That's this one. 136 days to go until expiration. It's going to cost me a little bit of money. It's going to be relatively expensive. In fact, it's going to be much more expensive than if I were to buy one with a short-term time frame. So I buy the one with 3 days to go. It's only $4 versus $20. All right. Okay, cool. I'm going to pay that additional time frame. I'm going to pay for that additional time because I know that I can sell that value back to somebody else at a later date. Right? You don't have to hold on to that time value to, her name was Lola. You don't have to hold on to that time value all for the entire lifespan of that option. Okay, but would you make a profit if the price moves in your favor? Yes, if the price of the underlying stock moves. Remember, if the price of the underlying stock moves, we bought this 250 strike, which is the at-the-money strike. We bought it out here 136 days to go until expiration. The price of the underlying stock moves up $1. That's going to add 58 cents to our option premium for every $1 that the underlying stock moves, and we're only losing 9 cents. But if we get down here, and we notice, look, we're right here at the at-the-money strike. This is, okay, so pay attention for a second, guys. This is a key component, and this is one of the reasons why we don't consider usually holding on to long options all the way till expiration or close to expiration. Look at this 250 strike. It's the at-the-money strike. Here we are, 3 days to go until expiration. Our delta at that at-the-money strike is still 56 cents, which means if the price of the stock goes up $1, our option premium gains 56 cents. But look at what we're losing for every day that passes. So we can gain $1 in the underlying stock. But if another day passes, we've lost all of that advantage. So as we get close to expiration, we're quickly very quickly going to get to the point where that tug of war between the rate of time decay and the amount of gain that we're getting from the price of the stock moving offsets each other or goes the other direction. Yeah, you got it now, Lola. Yes. Or for if the stock goes against us. So if you start seeing the stock moving down and you're losing time decay to that rate, man, that is really working against you. So if we're here at this point where we buy the option further out in time, and then we look at selling the option as we get closer to expiration, but not so far that that offset, the rate of time decay is close to our delta, then we have that advantage. We still have a directional advantage over the passage of time. The thing is, we can't predict directional price movement, but we can predict the passage of time. So what we're going to do is we're going to look at buying an option here with a slow rate of time decay, and we're going to sell that option back somewhere in this range, 31 days, 24 days to go until expiration, and expect that the price of the stock has moved in our directional favor. And if it hasn't, there's no benefit really in holding on to that close to expiration, hoping that it's going to turn around and it's going to go back, because at some point time decay is going to overwhelm the amount of gain that we could get in the price of the stock moving in the direction that we wanted to move to begin with. So think about closing long options down, selling them back when they've directionally done what we can expect to do, but before time decay starts to really kill us in that option premium. Okay, so let's look at an example. Let's go out here to our 136 days to go until expiration, and we'll go to our at the money strike, and we're just going to click on the ask price, and we're going to buy that at the money strike. We're going to just simulate this here for a second. So what I'm going to do is I'm going to right click and I'm going to go to the Analyze tab. Now, what we're typically used to seeing here on the Analyze tab is this, profit and loss, right? We're used to seeing, and you may not have used this particular tool, but we've got lots of great videos that talk about it. The Analyze tab is simply profit, in this case, profit and loss. This graph right now is profit and loss compared to the stock price. The stock price is on the x-axis, profit and loss is on the y-axis. And so we can model what that option is going to look like at expiration. The blue line is at expiration. That's when all the time value is gone. The purple line is what it looks like right now, or based on our inputs. And so if we've got those changes, we can see where that option premium might be at expiration. We can see our maximum theoretical loss or our maximum theoretical gain in the trade. We can use the Analyze tab to give us that information. But one of the other ways that we can use the Analyze tab is if we change this metric from P&L open to theta. So now you see what happens here with theta. You see this kind of belly of this curve that I've got here? And I'm going to kind of squish these strike prices together so that you can see what this looks like. You see how that looks kind of like an inverted? Yes, future divide. Bingo, you got it right there. So you see how this looks kind of like that inverted bell curve, right? Where's our at the money strike? Where's our at the money strike? It's right here. It's that 250 strike. That's the 250 strike that we bought. So over on the left-hand side, this left-hand axis now shows us theta. So let me grab my magic marker just so that we can remind ourselves of that. This is now no longer profit and loss. That's theta. This is still stock price. So you notice what happens to theta, to the rate of time decay, as we move from the at the money strike. The at the money strike has the greatest amount of time decay. It has the highest theta generally. So kind of in this range. It's not exact. None of these Greeks are absolutely exact. It's all dynamic and theoretical anyway. So don't get wrapped up on calculating it exactly. But you see that our rate of time decay over here on the left-hand side is 9 cents. That's what we saw on the option Greeks in the option chain. So what that means, though, is notice something. Let me kill my magic marker here real quick. And let's move our cursor or move our strike price. If we were to choose a deeper in the money strike, let's say we were to choose, say, for instance, a 220 strike, right? Going a little bit deeper in the money. It's going to cost more. If we were to choose a 220 strike, right here, that 220 strike, let's look at the crossover. That's got a lower rate of time decay. So here's the other tendency that options traders have a tendency to do. They have a tendency, because they're cheap, frugal, is they tend to buy an out-of-the-money option. And an out-of-the-money option, first of all, has no intrinsic value. And two, an out-of-the-money option, way out here, is going to cost a little bit less, but it still has, at a corresponding strike, generally a slightly higher theta. Has a slightly higher theta, meaning time decay is going to work against us faster on that option premium. That all that's there for that premium is time value. So it's working on every bit of that option premium. The reason this curve is a little bit skewed is because down here on the at the money side, when we go down here, these all have intrinsic value. These options out here above our at the money strike that don't have any intrinsic value, all this consists of is time value or extrinsic value. So as we get closer to expiration, what we can do is we can model what this looks like. So I'm going to put my price slice right there on 250. I'm actually even going to make it 250. We'll make it 250 exactly. And you can see what that theta is. Now, this is times 100 shares. But watch what happens. Watch what happens if nothing else happens. Watch what happens if nothing else happens but the passage of time to this rate of time decay at the money strike. So assuming that the price of the stock stays exactly where it is. And I just move forward. All I'm doing is I'm adjusting my date down here. Watch what's going on with that time decay curve. As we get further and further, or closer and closer, closer and closer to the expiration date. The expiration date of this option is the 20th of March. So here we are. Now we're getting closer and closer. Look at what's going on now at that 250 strike. Here we are at February 7th. That theta decay has now accelerated to 15 cents. Now, Future Divide says, how do we find the at-the-money strike consistently? The at-the-money strike is always going to be mathematically the closest strike price to the current trading price of the stock. Closest strike price to the current trading price of the stock. So we're assuming that the price of the stock has not done anything, okay? We're assuming that the price of the stock has not done a thing yet. But watch what we can do. As we get close to expiration, let's get down here. We're into kind of mid-February. And that rate of time decay has now accelerated to about 19 or 20 cents. Theta 17 cents. Let's get it to about 18 cents. Our delta is still 53 cents. So watch what happens if we adjust our stock price. When we say our stock price starts to move, you can see what happens to our profitability in this trade. It starts to kind of come back. We've lost a lot of value here simply because of the passage of time, but it takes a big move in the price of the stock to get back that value that we lost because of the price of because of that decay in time. So even if we've got a big move in the price of the stock, the fact that we let it go till close to expiration means that we're way behind the curve here. Now, one other thing to think about is this, and I want to kind of bring this, now we're getting a little bit deeper into this context. So let me just summarize this really quickly. For those of you that are newer to trading options, when you are buying a call option or buying a put option, think about buying more time. Think about buying more time than you feel you might need for the stock to make the move that it's going to make. And think about selling that option back at a point at which time decay has still not begun to accelerate. And you can model it here using the Analyze tab. You can do what we did on the option chain either way. Now what I want to do is I want to reset this. Okay, I want to come back to today, and I want to reset our stock price back to where it is. So now here we are back to today. What I'm also going to do in this discussion, okay, now what I want to do in this discussion is I want to add an out of the money option to this. And we'll talk about what that means. So what I'm going to do is I'm going to go back to my trade tab. I'm going to keep this one here. I'm going to go back to my trade tab. I'm going to go to that same date, and I'm going to go further out of the money. So I'm going to buy, say, for instance, a 280 strike call. And I'm going to pay a lot less, but it's out of the money. I'm going to right click and I'm going to send that to the Analyze tab. Now I've got both of these. I want to compare these. So let's take both of those off and let's remind ourselves where our 250 strike is. That at the money strike, we can see the rate of time decay, 9 cents. If we go to our 280 strike, it's about 8 cents, but it's going to be a lower rate of time decay. It's a little bit further out of the money. It's kind of worked its way. Here we are right here. It's kind of worked its way down this edge of the curve, but it's still eating away at that premium. We don't have any intrinsic value. So if the price of the stock, if we were to go to expiration, the price of the stock were to not move at all, we don't have any value in that option. Now, the other thing to think about is this. As we get close to expiration, I'm going to take this out of the money option till expiration. We'll take that 280 strike closer to expiration. So I'm going to come back here and I'm going to say, all right, where are we going to go? We're going to go to January, February. Let's go to, we're just ahead of that March expiration. Let's go a month out from that March expiration. So if we're right here on this curve, the acceleration of that time decay, here's what that out of the money option time decay curve looks like. The majority of that out of the money time decay is going to come in the beginning stages. And as we get closer to expiration, that rate of time decay tends to not accelerate, but slow down a little bit. So we might think, oh, I'll just buy a far out of the money option, but recognize that if the price of the stock doesn't move quickly, you're taking or suffering from the majority of your time decay early on in the lifespan of that option. So 2 considerations. 1, buy a little bit more time than you think that you might need, and buy an option maybe a little bit more in the money than you might think so that you can sell intrinsic value back and sell more time value back to somebody else. Now, when you come to my trading index options class on Wednesdays, and I teach that at 3 p.m. Eastern time, we talk about how as the seller of an option, we can put this factor to work in our favor as the seller of a short-term option. But I wanted to take this simply from the perspective of being a long option trader first and understanding the impact of time decay and how we can model that on our option premium. So again, I know we got a little bit deep there, but hopefully this helped you to understand and clarify some of the aspects of time decay when it comes to our option premium. Now we understand that this curve, it has a little bit more context to it in terms of why we look at this as an out of, or as a long option trader, the buyer of a call or the buyer of a put. So if you want to learn more about this idea and about these concepts, do this. Pop over here to our Trader Tax webcast page. Let me just come back to our home page here really quick and type in time decay. And you're going to find Michael Fairborn talking about that. Higher time decay with Thinkorswim tools. Time decay can boost pattern based trades. Theta edge, understanding theta decay in a meaningful way. You find a lot of resources. I like this one that Rachel did, using ThinkBack to understand options pricing. So a lot of great information there. Where do you find that Wednesday Index Options webcast? So that's where you're going to come right back over here to our coaching page, schwab.com/coaching. Go to live webcasts and virtual workshops. Come down here to each Wednesday. And here it is right here. Tomorrow, you'll see it right there. You can go right there. You can set yourself an email reminder for that webcast, but it is at 3 p.m. Eastern time. You can find it right here and join that webcast. By the way, helping you out again, remember, don't defy time here. Click on that feedback survey and fill that out. Where do you find all of our upcoming in-person events? Come right over here to the schedule for in-person events. You're going to see we're doing a market drive in Anaheim, then we're doing Houston, and then we're doing Miami, and then we're doing Dallas, and then Seattle. So we got a bunch of a bunch of live workshops coming up. Now, when you come over here to the Trader Talks webcast page, we have one simple ask of you, and that is just click on that subscribe button, give us a follow. That helps you to find this information again. It helps other people to find the information again as well. My thanks to Michael Fairborn for helping me out today. My thanks to our great producers for helping to bring this to you. And my thanks to all of you for joining me today. And we will see you guys again very soon in our Trader Talks webcast. We'll see you then. Take care, everybody. Bye-bye.